and welcome to this new episode. Today I have David. David, he's our account manager over NewFi. Welcome, David. How are you?
I'm well. How are you doing?
Good, I'm doing well. And I'm so glad that you are here with us because I wanted to talk to you, well, for you to explain to us different programs that are not very well known. So like non-QM products. And today we're going to be talking about the two CPA programs you have available. Can you tell me a little bit more about them and how they work?
Sure, most definitely. So as you mentioned, we do have two CPA programs. We have the CPA P&L program and the CPA Gross Receipt Program. So let's start with the P&L program. So basically, what the CPA P&L program is it is, rather than our traditional bank statements where we get the most recent bank statement and calculate the expenses and so forth. The P&L is, we obtain the most recent P&L. So not last year's P&L or last quarter's. It has to be the most recent 12 months. So the CPA would provide that to us. And then in addition to that, we would just provide 4 months of bank statements simply to support the gross income. Okay, so whatever stated at the top of the P&L as the gross amount, the bank statements just have to support 85% of what that is.
Perfect. So, okay. Right. And that's in both CPA programs or just one?
Both CPAs would require that the bank statements to show 85%.
Perfect. Okay.
So the main difference between the two is that the P&L is focused on truly the last 12 months. So for example, if we're in June, your last 12 months, you're going to start back at May, going through June of the prior year. The gross receipts is starting strictly focused on what the gross receipts were for the last tax filing. So as we know, self-employed people, they write off as much as they can, right? Yes. Okay, that's why we're talking. Yep. But so we aren't going to pull transcripts on either program, so you don't have to worry about 4506s or anything of that nature. But so what the CPA is saying on the tax receipt is that this is what the gross receipts were. This was the top line that we filed in last year's returns. Okay, so that's it. Now, the one downside to the gross receipt is if we're more than halfway through the year, then the program requires 6 months of bank statements.
Oh, okay.
To support it. So if we're in October to say, strictly go off of last year's, that's a little too far. So that's why they want 6 months.
Got it. So, and what would be the credit score for both loans? What's the minimum credit score?
Okay, for now that's driven by also LTV. So for example, if you are looking to go 80%, you're going to need LTV or 20% down on a purchase. You're going to need a 720 score. Okay, but if we're looking at going, say, 75%, then you can get by with a 660 or 680 score.
Got it. Okay. So also, what's the down payment amount and the reserves?
Mm-hmm. So the reserve.
Like so tell me a little bit more about the reserves.
Okay. So so our reserves are based on loan amount more so than the risk factor. Okay. So we default to a 3 month 3 months reserves up to 750 a loan amount. When you get over when you get over 750, then we'll go up to, we can go up to 6 months, we can go up to 12 months. So it's a tier with loan amount. You're not going to get into the high reserve point until we're up over like 1.5 or 2 million. So traditionally, like I said, 3 months if you're up to 750.
Got it. Okay. All right. And what are one of the requirements when it comes to this type of loans? Because I know we're talking, and David, I so much appreciate you coming on board and kind of explaining this, because
Oh, sure.
I'm always asking you questions, and I thought it would be good to just record it so other people can actually learn about the products as well.
Oh no, I
And
appreciate it, because we've done, to your point, we've done so many. We've done
yep,
between DSCR, the bank statement, and now these. I think it's great to give the wealth of knowledge to everybody.
yep. So you were talking to me about they have to be at least 50% owner of a company.
Correct, correct. I mean, the vast majority of what we get are 100% owners, but they're not required to be 100% owners. They can be any percentage up to 50%. And I know in our conversation, you asked about exceptions. The
Yeah, what
one,
are like 49%
yeah,
ownership?
right, right. So the one good thing about NewFi is that we are owned, or that our parent company is Apollo, and Apollo is the third largest equity firm, either in the nation or the world. I'm not sure, but they're huge. And what does that mean to you? Well, it gives us some flexibility, because a third of our loans that we fund each and every month have at least one exception. So to
Yep.
this point, when we usually encounter a percentage of, say, 49 or 48, we've been able to get it done. And one, because of who our parent company is and who buys 95% of our paper, but also because there's typically a reasonable or a meaningful relationship between that business partner. It could be a spouse, it could be a brother, it could be, there's usually something tangible there, that we can really lean on. But also we look at compensating factors, for any exception. So if instead of putting 20% down, they're putting 25, or they have their business has been, in existence for 10 plus years, there's always something, whether it be their prior mortgage history. So we can offset it. But yes, we can make minor exceptions, but as a rule of thumb, yes, it's probably best to focus on that 50% and above.
Got it. Okay. And what would be the required documentations if someone wants to get this type of loan? What can they start preparing for?
Okay. Well, the great thing about pretty much all of our programs that NewFi tries to do is just keep the simplicity of them all. And that's one thing that we were talking about earlier, is that this loan is really no different than any of your other loans, except for the income piece of it. So when you're prepping everything together, it's great. It's all the same. With regards to the P&L, it's just it would be coordinating with the CPA, and just make sure that your request is clear, because whenever CPAs always, like I mentioned earlier, seem to focus on quarterly bases. They want quarterly returns, they want whatever. So just to stress to them to make the most, it has to be the most recent 12 months. That way it just prevents any frustration or going back and forth with the CPA, or God forbid they charge them extra.
You also mentioned they have to have a relationship with them, and this have to be a licensed either CPA or tax preparer, right?
Correct. So it doesn't have to technically be a CPA. As long as it's a licensed tax preparer, we're fine, because we are going to confirm that. When they are preparing it, with the CPA letter, they're going to do the CPA, they're going to do the P&L. If it's the gross receipts, they're going to provide a letter which includes the gross receipts. But what they're going to also do on both of them is they are going to basically have to state, who they are, provide their license, state that they have done, especially on the gross receipts, that they have filed the tax returns for these clients for the prior year. we will default on the gross receipts. We have to apply an expense factor. So we will automatically default to our 50% expense factor, very similar to what we do on the bank statements. But we do follow the same philosophy that 50% is conservative. If their expense factor, yes, if their expense factor is far less, then if the CPA states that a more accurate, the true and more accurate expense factor is 20%, because we deal with a lot of our loans come out from either gig workers, self-employed, Schedule C, what be it, but we do a lot of consultants. We do a lot of, IT coding individuals. We do a lot of laborers. Well, there's not a lot of overhead there. It's just services.
Exactly.
So if it's lower, that's all they have to do, and we don't do any validation. I mean, there is the common sense factor. I mean, if somebody, if it's a restaurant and somebody says, "Oh, their expense rate is 15%," we're not going to buy that.
We're actually working with one client together, and she works from home, and she is, I believe, she just codes medical coding.
Oh, right.
She has no expenses.
No.
She's just a 1099 person, and so this definitely would be a good program for her. So what would be the ideal target for this type of programs for the gross receipts and the P&L?
Well, obviously it's probably, well, I'd say smaller to mid-size, but I'm doing one. I have one going right now where the monthly came out to be $182,000 a month of income, and their 4 bank statements supported that. So what I would say is, whenever somebody comes and looks for a bank statement program, for example, because that's what most self-employed people think. If I can't provide, if I can't prove my income based on tax returns, because I do, like every self-employed person does, of maximize the opportunities that we have. If they say they want to go to bank statements, then ask why. Because like you mentioned the 1099, we have a 1099 program as well, which
we're going to have another video on later on. So you guys can look up.
No. Right, but it does fit. That does fit some people. But it's usually the path of least resistance, because if you go bank statements, you do have certain things like NSFs or overdrafts, and it's not necessarily a borrower's fault. Sometimes their accounts receivable come in the same day or the day after a posting. Well, it makes perfect sense, but that could throw them out of qualifying. So if you know that, you may want to go, let's go with the gross receipts. It really comes down to both programs, the CPA or tax preparer. If the borrowers have a good relationship with them and they're willing to, we have some CPAs that would prefer to do the gross receipts, because all they're saying is, this is what I filed on last year's tax returns, and I've worked with them, they're 100%, and that's it. As opposed to do, maybe a labor intensive of creating a whole new P&L, a third of the way through the year. So it really comes down to that, but it does provide the flexibility for both.
It definitely does. I mean, having that flexibility, it helps a lot of people that are self-employed and they just cannot qualify for a traditional loan just because of their taxes and whatnot. Now, let me ask, just to kind of wrap things up, whenever if we're considering doing this type of loan,
Yes.
CPA P&L or CPA gross receipts, what is the interest rates look like compared to a regular conventional loan? Because normally I see it's about 1% to 1.25 to 1.5% higher. But that's just coming from me looking at a bunch of different loans. What do you think?
Well, in some cases, my opinion is going to be a little skewed, because we are focused strictly, NewFi is focused strictly on non-QM. Okay, we do, when market changes, we have the ability, we're full legal, HUD approval, we have everything, but we do what we do best. Let the UWMs and Rockets take care of everything else.
Yep.
So what we'll do this, right? But I can tell you that, you ask initially why we get these. You can't believe how many transferred appraisals we get from UWM and Rocket because something fell out, and we can do it under these programs that you're talking about today. So that helps. With regards to pricing, the good thing about these programs is where pricing gets most impactful is over 80% LTV. That's where your loan level price adjusters really take shape, shall we say.
So
But
meaning giving 20% or higher.
correct. So you're right. So these programs are limited to 20%. So bank statement can go up to 90% LTV. Well, the pricing between 80 and 90 gets hit pretty hard. Since this one is limited at 80, it's the pricing usually is pretty compatible. I mean, I have two of them going right now, and they were at borrower paid. I think one was at 6.875 and one was at 7.25.
Okay,
Right there
for you guys looking at this video, whenever he says borrower paid, that really means that on your closing cost, you will have to ultimately pay the compensation for the broker yourself, which is capped at 2.75 most. Well, it's just capped at that. I don't know what the broker would charge because everyone charges differently, but it is capped at 2.75, and that's you can Google it. I mean, it's a law, so it's not really that anyone would make that up. But that's what it means on borrower paid. So where your closing costs are going to be a little bit more expensive, rather than if the lender is the one compensating the broker themselves. So that's truly what it means. I wanted to give some clarity around it.
Oh, exactly. Thank you for that, because we could also increase, so that would be at that par rate, or that if they're paying, but not everybody has the liquid assets to be able to do so, to meet the reserve requirements in that nature. So they have the ability, if their debt ratio works, to increase the rate slightly to get lender credit so that we can pay that on the backside. So they will have that flexibility. But I would say even going that route, you're looking at rates in the mid sevens. So they're very
good, because the interest rates right now, they are around the 7%.
They are, and that's what's so surprising right now. I mean, we do have some inflation numbers that come out tomorrow, and we'll fingers crossed it doesn't impact the market. I mean, it's across the board. It's not just non-QM.
Yep.
But at the end of the day, the rates are they are competitive, and we aren't far off at all from the conventional side. Like there used to be such a huge gap.
Mhm.
It's not anymore.
Yeah, and I have found that to be true, though, because sometimes we were getting some I was quoting a loan, and the DSCR seemed a little bit cheaper than the bank statements, but both of them are QMs. But then when I was actually putting another loan for another client, a regular conventional loan, 5% down, the difference was like almost nothing, and I was very surprised by it.
Yeah, no, you're right. And what the strange thing is that you referenced the DSCR. There are times right now in buckets that our DSCRs are priced better than our bank statements. And it's the appetite on the secondary market. But the one thing about the DSCR too is they can close quick. So it's because it's so much appraisal.
What is that time? Well, but we'll go ahead and talk about DSCR and loans.
I'm sorry, you get me excited about other things.
I know. So you guys at home, if you are, let me know what type of loan product, non-QM, which means it's outside this conventional and FHA type of loans. Let me know what type of loan you wanted to know, and then we'll come back with David, and he can give us some expertise and knowledge around them. So David, thank you so much for coming. I'll hope I hope I'll be having you next week to talk about some other new non-QM products that I just want to teach everybody. And then it's just good for a refresher. So thank you so much. And I'll see you guys next week. Bye-bye.
Thank you.